Governor, thank you so much for speaking to Bloomberg.
Pleasure.
How worried are you about a second wave?
Well, we're following it very closely. We're not medical experts, so we follow it very, very carefully. What I would say is, I think we put in our forecast two things really. One, we've got a very big downside skew in our forecast for risks, and we've got the biggest ever margin of uncertainty in our forecast, which I think is probably unsurprising given where we are. And that obviously, the combination of those two things, encompasses a very sort of broad range of things that could happen. Specifically, our forecast allows for quite a lot of localized outbreaks, localized responses. I think that's helpful. We have not assumed any sort of medical breakthrough. We assume gradual progress in reducing uncertainty, but with no specific milestones, events, because we're not experts in that either.
So how would you model, for example, a London lockdown? What does that do to forecasts?
Well, I think that the larger the lockdown, the further down into our fan chart it would be. But it is a very big downside skew, so we've got quite a bit of scope for interpretation there. But I'm a big supporter of what I think the government is seeking to do, which is to try to use obviously smarter measures, localized approaches to tackle this.
Governor, do you think the forecasts are too optimistic?
No. I don't think at all. I think the central case in the forecast is a reasonable representation of a central case. What I would say, and this is why we issued the guidance we did, that there is a very big downside skew. I think there's a lot of hard work to be done to get the economy back to where it was. We've had quite a rapid recovery so far, which I'm not surprised about as restrictions get lifted. But there's a lot of hard yards to be done from here onwards. And the reason that we issued the guidance, in my view, was to say, look, the forecasts can sometimes look beguilingly sort of, straightforward. There's an awful lot of risk in there, and it's obviously distributed one way. And we will be therefore ready to lean in, as it were, and support that.
The first half GDP in the UK was down some 22%. It's one of the countries that's been hit the most. Why is that?
I think it's a combination of things in the UK. I think partly, of course, obviously it's timing of the incidence of COVID and lockdown measures. But I think the second thing about the UK is that it does have a higher share of activities in the economy that are most affected. So it's got a higher share of what we might call sort of social expenditure services, whether it's restaurants, entertainment, those sorts of things. And of course, it's those activities that are most, if you like, people intensive, where people have to sort of have to be in close proximity to do them, that are most affected by the restrictions, fairly obviously. So there is an element of that as well. When we look at the structure of the UK economy versus the US, continental Europe, we do see that feature.
Should the government do more to support the economy right now?
No, I think the government is doing very good things. As you know, I work very closely with the Chancellor on this. We've worked very closely together with using our respective toolkits. I think it's been a success. I think the furloughing scheme has been a great success in that respect. So I'm a strong supporter of what they're doing.
If there's a second lockdown or a big second wave of infection, would you worry that you don't have enough ammunition?
Well, we look at the toolbox repeatedly. It's an interesting reflection that if you go back to what almost seems like prehistory now, in fact it's February, Mark Carney and I both made comments about what room for manoeuvre we thought we had in that world in terms of monetary policy. Frankly, we've ripped the script up since then and done far more than I think would have been envisaged, or we envisaged at that point in time. That's the right thing to do. And we have to go on assessing the toolbox. There's no question about that. And that's why we've said what we've said about, the fact that negative rates are in the toolbox, but we're not planning to use them at the moment.
Are you looking at yield curve control?
Well, I would say the things we've looked at are broadly further QE, further quantitative easing, potential use of negative rates, and forward guidance. Those are the things that we've looked at.
So yield curve control has not been discussed, or is it something
obviously yield curve control is quite interestingly discussed in central banks, and we do discuss it. It's something that, we've preferred to look at quantitative easing and forward guidance as tools in that respect. But I would make the point that we will go on looking at the toolbox. Nothing is fixed down forever, but it's not in our planning at the moment.
Have you considered going negative on the term funding scheme rate?
Well, I think that would be part of any consideration if we get to the point where we're saying now might be the time that we would have to look at the question of the term funding scheme, because the whole point about the term funding scheme is to reinforce the effect of the official rate setting. Now, there is a challenge with a negative rates term funding scheme. I have to be honest with you about, obviously, is it becoming almost a fiscal measure at that point? In terms of, is there a subsidy then implied by it? And we would have to look very carefully at that. We're not anywhere near there at the moment, but that would be part of the consideration if we got to that point.
Do you see it before going fully into negative rates, or how should we see the sequence? How should the markets look at the sequence of this?
Well, no, I don't see a negative term funding scheme as being a prior step in that sense. We've tended to always use it as a step that goes alongside a movement in rates, and I would envisage that would be the consideration we would have at the time. I wouldn't envisage a different sequence.
So, what would it actually take for you to go into negative rates? Like what kind of scenario?
Well, I'm not going to give you a precise time. What I would say is this: I think the issues that we most focused on, and we've talked a lot to the central banks that have done them. Those have gone in, come out, gone in, not yet come out. Really very, very helpful and fascinating conversations, lots of the work they've done. And I'll draw 2 points out of it. One, as you get into this territory, there is, I think, a much bigger interaction with the structure of your financial system, and particularly the structure of your banking system. Nobody has really sent retail deposit rates negative. And I can understand why. Obviously, it means that the bigger the share of retail deposits in your banking system funding, the more attenuated the effect of negative rates will be. We've actually got quite a high share of retail funding in the banking system here, and we've got ring fencing as well, which is in a sense structurally, it's been a deliberate response to the crisis, because we always used to spend our time on the wonderful thing called the customer funding gap. And ring fencing, of course, in a sense structurally embedded that. So that's one thing. The second thing that I would conclude, looking at the experience of some of the other central banks, is that the effectiveness of negative rates does depend upon what point in the cycle you're using them at as well. And again, that's an interaction with the financial system as well.
But so would you see yourself using negative rates, post-COVID, so in a recovery phase, to actually help the economy then?
Well, I don't know is the answer, because we're not facing that situation today. I think it is true that when you look at the experience of other countries, they appear to have worked more effectively in the recovery phase. Now, I would, however, qualify that a bit by saying I think there's a tricky identification issue at that point as to what extent it's negative rates that are driving, for instance, the recovery of the banking system, the lifting of the release of provisions, and therefore the ability to lend, and to what extent that would have happened anyway, because it's a cyclical point. It's a rather tricky issue in that respect. So the evidence is there, but it's a little bit hard to identify the causes.
But then again, in terms of sequence, it's not something that you would rule out, right? It could happen at that phase.
Oh, definite message we're giving today is, look, they're in the box. There are other central banks that have said they're not in the box because, again, their financial systems have got different properties and they draw different conclusions, so I can understand that. They're in the box. We're not considering using them at the moment.
Governor, what would you say to those that say that QE is basically not helping climate change because of what you're buying?
Well, I think the QE and climate change issue is one that we've got to come back to. I've been very clear that I said, again, in what seems like this sort of prehistoric age before COVID, that I wanted to look at the question of the corporate bond portfolio, what the right benchmark for it was. By the way, that's a decision we have to make with the Treasury because the risk in that portfolio is with them. I still am in that position. To be frank with you, given the emergency and the crisis we've had to face, we don't have the time and resource to do that work at the moment. But I would say to everyone, because I've had a lot of letters on this subject, quite understandably so actually, please don't think that we've moved away from our ambition. We've just had to be, frankly, pragmatic about what we can do.
Governor, final question. When you look at the end of the year, if we have a no-deal Brexit and a second wave, how much would that be just, the horrific storm, perfect storm almost?
Well, obviously, the planning is that it's an outcome on Brexit that is agreed in the sense that there may not be a deep trade deal, but there would be an orderly move to, say, a WTO arrangement. On the point about Brexit and COVID, I would say this. COVID is the bigger shock in our we've looked at this quite sensibly. It is the bigger shock at the moment. What is quite complex, though, of course, is if you think about your scenario, is to unpick them, because both of them could be negative for trade. Now, COVID has already been negative for trade. So then you get the complicated question, if you're thinking about that type of scenario, which, by the way, is not obviously our central assumption, but very clear on that, is how they interact, because COVID has already had an effect on trade.